Welcome to the module on Basics of Accounting, Part 1. By the end of this module, you will be able to learn about different types of businesses, their advantages and disadvantages. Learn about common accounting terms. Understand the flow of money in a business. Learn about common sources of capital in business. The primary objective of any business is to make money for its owners through the sale of goods and services. Three main types of general business organization are sole proprietorship, partnership, corporations. A sole proprietorship business where there is a single owner. The owner is responsible for day-to-day activities and operations of the business. There is no distinction between the owner and the business. All profits earned through the business are taxed as personal income. The advantage of sole proprietorship is that there is one person who owns as well as runs the business, interlocking interests entirely. The disadvantages of sole proprietorship are many, such as problems arise when the owner differs from the person operating the business. Uncertainty exists about what will happen to the business after the death of the sole proprietor. Due to this uncertainty, it is very difficult for sole proprietorship and small companies to raise capital from various sources. Personal assets can be used to cover business losses, leading to what is called unlimited liability for the owner. A partnership is similar to sole proprietorship, but involves multiple owners called partners. In a partnership, only a set of partners may be involved in managing daily business operations. Some partners may be passive or sleeping partners who invest capital but do not participate in daily operations. The disadvantages of partnership are as follows. What happens if a partner dies? Will the business survive beyond the partners' lives? This uncertainty makes it difficult to raise capital. Partnerships often remain small companies due to lack of sufficient funds. Potential conflict of interest may arise where an actively involved partner may act in their own best interest, not necessarily in the best interest of inactive partners. Some examples of partnerships are grocery shops run by siblings, consulting firms, law firms, accounting firms. A corporation is a separate standalone legal entity, distinct from its owners. Owners are known as shareholders. Management is appointed to run the corporation's day-to-day activities. The corporation and its owners have separate PAN numbers. Clear separation exists between owners, shareholders, outsiders, and managers. Examples of common corporations are Life Insurance Corporation of India, State Bank of India, Reliance, Airtel, ICICI Bank. The advantages of a corporation are corporation longevity, not dependent on a single owner or group of partners, hence no uncertainty about lifespan. Capital raising, easier than other business structures, allows corporations to grow larger and employ more people. Limited personal liability. Owners are only at risk of losing the amount invested. They are not personally liable for losses. The disadvantages of a corporation are conflict of interest. In a corporation, the owners are shareholders, and they appoint managers to run the company. However, this separation can lead to a conflict or misalignment of interests between shareholders and managers. Double taxation. Profits earned by a corporation are subject to double taxation. This means that the corporation's earnings are taxed at the corporate level, and when these profits are distributed to shareholders as dividends, they are taxed again at the individual level. This system of double taxation can result in an increased tax burden. Now, let us understand about hybrid structures. A sole proprietorship company is a legally distinct entity from its owner with limited liability, whereas a limited liability partnership is a standalone legal entity separate from its owners and also enjoys limited liability like a corporation. Accounting involves recording and reporting day-to-day transactions and tracks inflow and outflow of money in business. Account statements are essential for future planning. It is focused on reporting historical transactions. Finance involves economic operations, future planning, and decision making. It uses past financial data to project future outcomes. It is focused on planning for an uncertain future. Let's now learn about some accounting vocabularies. Liabilities. It represents capital raised by the business from various entities that have to be repaid. Payment obligations must be fulfilled or company assets may be seized. Some of the examples are bank loans, leases and cash payments, taxes. Next term is equity. This is another source of capital for any business. There is no obligation or promise to repay the equity providers. When you buy shares of a company, you become a shareholder. If the company makes profits, the value of your shares increases and vice versa. The company is not obliged to return the amount you spent to buy its shares. The only payment that equity holders receive is called a dividend, and you can sell the shares to receive a profit. Assets. These are any type of machinery, building, land, furniture, equipment used to run the business. Revenue. Also called sales, revenue is basically the income that any business earns from producing or providing products and or services to its customers. Cost. The expenses incurred to run a business and services are called cost. Examples of cost: salary of employees, labor cost, cost of raw materials, cost of purchasing goods, services, GST, and income tax. Let us further understand how money flows in a business from start to finish. It flows in the form of source of capital, investment and assets, business operations, revenue, profit, sources of capital. Liabilities and equity are two sources of capital for any business. Capital needs to be raised before you can make investments and generate revenue. Investment and assets. Once the capital is raised, it can be invested in assets. These assets are used to generate revenue for the business. Business operations. Assets are used in the production of goods and services that form the primary operations of the business. Expenses include costs for salaries, raw materials, payments to vendors and suppliers. Revenue is the income received from selling goods and services to customers. Profit is calculated by subtracting costs from revenue. Costs include debt repayment, interest on debt, expenses, taxes, and dividends. The decision to pay dividends to shareholders is made by management and may or may not happen in a particular year. Any business relies on two common sources to raise capital. Debt. A business borrows a loan or principal amount from a lender for a fixed period. The lender can be a bank or a non-banking financial corporation, NBFC. It can also be through debentures. Some of the sources of loan are banks such as State Bank of India, ICICI Bank, Canara Bank, etc. NBFCs such as Bajaj Finance Limited, L&T Finance Holdings, HDFC Finance, etc. Second source of capital is debenture. This implies taking money directly from investors. These are actually applicable for large established companies. There are two ways of investing in a company: buying shares and buying debentures. Buying shares means becoming a partial owner in which the management decides whether to pay dividends or not. Buying debentures means the company has to return the loan amount and interest to the investor. But the company pays the interest through coupons once in 6 months. The principal amount is paid at the end of the life of the debenture. Both shares and debentures can be bought in the stock market. Loan interest and EMI. Loans come with an interest rate. Equated monthly installments, EMIs, are paid to the lender on a monthly basis. The EMI consists of the outstanding principal amount and a part of the interest. Debt default or loan default. When a business fails to make EMI payments, it is considered a loan default. In such cases, lenders have the right to take ownership of the company. They can sell the company's assets to recover the outstanding amount. Equity refers to the shares or stock of a company. Equity holders are also called shareholders or stockholders, and they all refer to the same thing. Equity holders are owners of the company, but they're not promised any fixed payment from the company. Thank you.